welcome to the Monday edition of the Dividend Cafe. I am your host, David Bahnsen, managing partner here at the Bahnsen Group, sitting in our Newport Beach studio with a day of goodies to present for you around the horn in the normal topics we like to cover on a Monday. A lot on the Fed today, a lot on housing, a lot on the economy, the normal market stuff. It's funny. For a market podcast, the thing that I think is most irrelevant each and every Monday is the daily recap of market action. We do it as a bit of a courtesy. Of course, we provide the daily blurb Tuesday, Wednesday, and Thursday as well, which is largely an excuse to present also the Ask TBG to give you answers to different questions that come in. But what the market went up or down on a given day is perhaps the most irrelevant statistical data point I could ever provide. Now, to the extent some people want to know, and we'd rather they get it from us than someone else, I mean, we have no problem presenting the number. But I just thought every now and then it might be helpful to refresh you as to what we actually think is important. And one of those things is not how many points up or down the Dow went in a given day. A lot of the other things we're going to talk about are important. So we'll get to that. For those who missed the Dividend Cafe on Friday, I do heartily recommend you go to dividendcafe.com, where we will have a very special Friday edition about the markets, the market economy, the system of free enterprise in the United States that we think serves as the secret sauce to American investor success for so long, and a sort of a philosophical refresher as to the nature of free market economy and why it is so relevant to relative U.S. strength over other markets, and where the uniquely American celebration of risk-taking and entrepreneurialism has been such an incredible driver of economic growth in the United States for so long, and what that means for investors. So check that out at dividendcafe.com. All right, so the market here Monday, September 8th, opened down a pinch, and then it did bounce up and then down and then up again, ending up the day up 114 points, which as a percentage is a whopping 0.25%. The S&P was up 0.25%, and the NASDAQ was up a little less than 0.5%. So all three major market indices up, but none of them up a lot. What was up again was the bond market, as the 10-year yield fell another 5 basis points. The 10-year is barely holding above 4%, so the bond rally has continued up and down the curve. Right now, the 10-year closing at 4.04%. This is an incredible message that the bond market is laughing about inflation talk, and yet telling you not to laugh about growth. That growth is indeed slowing. This is a byproduct of nominal GDP expectations coming lower. The top performing equity market sector of the day was technology. It was up 67 basis points. All of the defensive sectors were down today, and the worst performing was utilities, which was down a little over 1%. A surprise worth mentioning, though, speaking of risk assets. Outside of the defensive sectors, you have small cap stocks that have done very well, both on a relative and absolute basis as of late, and the home building stocks. And the home builder sector does not seem to be one that should have a lot of strength given the challenges within the home building world. But again, markets themselves are always and forever a discounting mechanism. In terms of public policy, I actually don't have a lot to update you on. The various mouthpieces for administration made their way around the Sunday morning news shows, but there isn't anything particularly newsworthy to update. No new policies announced, no new activities with various trade deals, just your normal kind of cheerleading and quarterbacking and whatnot. But I will say that there's more talk about a second reconciliation bill, and I remain very skeptical that the politics are such that something like that could get done. There are things that might be popular that could get some yes votes, but then those very things that could generate some yes votes to get a second reconciliation vote done would cost it votes with others. And so there isn't, the question is whether or not there are enough things that could harmonize the people that would be polled on yes and no on various particular issues. What would be the harmonizing force to get us to 50 or 51 Republican Senate votes? And with the last reconciliation bill, there were so many things that would have killed that bill, that put various forces at odds with one another. But what harmonized it to get it over the finish line was the sort of political urgency of the expiring tax cuts. And with that issue taken away, I just don't see what the uniting force is that is going to coalitionally allow a yes vote for another reconciliation package. I don't see it happening. That doesn't mean it can't. And maybe there's something so small ball that it does happen, but it barely even matters. But I'm not sure. Reconciliation bills are hard. And I don't see a budget window getting opened and then a reconciliation, whether it's within a new budget window or the prior, that is going to get the votes necessary without a political emergency attached to it. Okay, I've gone on too long with other things because I want to get to the heart of the matter here, which is the economic front. First, last Wednesday was the ADP number, whereby for the month of August, you had a pretty atrocious result in the private sector, 54,000 jobs created, and that was half of the also low number from July. So you now have a 3-month average in ADP private payrolls, 46,000 private sector jobs created per month, and there's a 12-month average of 120,000. So you're getting close to just 1/3 of the per month average over the last year. But then, as I've said many times, the ADP number sometimes is not a great leading indicator to the BLS number, the Bureau of Labor Statistics, which is the official governmental data. Sometimes those things are at odds. But in this particular case, the BLS number was even worse, with 22,000 jobs created in August and downward revisions when the administration had predicted upward revisions for June that actually put the June number in the negative. So payrolls were only 22,000 in August. That's the worst month in a long time. And the unemployment rate rose to 4.3%. Firings have still not picked up. We're not seeing a substantial amount of layoffs, more than before, but not a high number. But the issue is you're not seeing a lot of new hirings. So there's a certain degree of frozen activity in both the hiring and firing front, which is not what you want out of a robust job market. The trade deficit in July came in at 78.3 billion. Imports were up an astonishing 20 billion. Obviously, a mad dash for American importers to front run tariffs. And July gave a window to do that before the August announcement of new kind of reaffirmed tariff levels and impositions. Manufacturing jobs declined for the 4th straight month. The negative job growth we see, by the way, are all in tariff-sensitive sectors: manufacturing, mining, logging, construction, wholesale trade, transportation, warehousing. There's a chart to this effect at dividendcafe.com. On the housing front, I continue to be asked what the administration can do. I presume people are referring to the Trump administration about the housing issue. And I want to continue to make the point that primarily these things are supply driven, which is primarily state and local, and very little the administration at a federal government level can do. Now, with that said, I suspect it's possible that they end up easing enforcement on immigration in the construction industry, much like they were pressured to do in agriculture. I do believe that certain tariffs on construction materials are having a huge effect on housing builds, and there is room for some sort of relief about that. But I don't know that they will. I only know that I think they should. Now, lower interest rates could help, but this is somewhat paradoxical because we generally associate lower interest rates with higher housing prices. How is that going to help an affordability issue? But what you do have now that is very unique historically is a frozen market, what we're referring to as a seller's strike, where rates are so low that sellers don't want to sell and trade out a low mortgage to go have to buy a bigger and more expensive home, but at a higher interest rate. And there's a possibility that you at least unfreeze activity that then is beneficial to driving some housing market activity that might help recalibrate, recenter, rebalance supply and demand. Uh, so I think ultimately the administration is not likely to be able to do anything about the zoning and permitting and regulatory roadblocks that exist at a state and local level. So this is our framework around housing. Another data point that I want to hit real quick that I read in a report last week from 2012 to 2019. So think of it as the post crisis, pre COVID moment, went over almost a decade. You had between 200,000 at the low end and 300,000 at the high end every single year, new home purchases by foreign buyers. That number is now below 100,000 each of the last 4 years. So you are just simply not getting a lift in transactional activity from foreign buyers. It's taken out a net couple 100,000 a year in this activity. That's a big part of declining volume. Okay, so the Fed, this is just absolutely amazing in light of the atrocious jobs results last month. They're now 88% chance of a quarter point rate cut from the Fed next week, but it's a 12% chance of a half point. So there's a 0% chance of no cut in September. Most likely, according to the Fed funds futures market, a quarter point, small possibility right now of a half point. But then more interesting to us is that in December, there is now an 80% chance that the Fed will be 3/4 of a percentage point lower, 75 basis points lower by the end of the year. And there's a 9% chance of a 1% reduction by the end of the year, back to 100 basis points coming out of the Fed funds rate by the end of the year. The odds for that third rate cut were let me think here. Just last week before the jobs data, we're at 24%. They're now at 80%. So more than tripled in light of that job number. The president himself, by the way, on Friday said his top 3 finalists for the next Fed chair are Kevin Hassett, who's the current NEC chair, Kevin Warsh, who is my preferred selection, and Christopher Waller, who is a current Fed governor. On the oil front, WTI closed 62.41 today, up 1% on the day. It was down 3.5% last week. More talk of OPEC plus production picking up. Whole energy sector was down last week. Midstream itself was down about 2%. There is a chart and some statistics I brought back the against doomsdayism this week because I came across the data points on Sunday and I just felt the desire to share it because I continue to hear more and more of this malarkey about how badly our public health is failing us. And the fact of the matter is that death rates from leukemia in small children has plummeted by 93% since 1950. Total cancer deaths have dropped 34% since 1991. That is a byproduct, of course, of much better early detection emphasis and, of course, certain behavioral and preventative issues, primarily around lung cancer, smoking. My point being, whether you're talking about heart valves or cancer detection, there's been some just staggering improvements in modern health and science that I feel we should have gratitude for. And for that reason, I remain against doomsdayism. Longer question and answer that I won't do here on the video or podcast, but you could check out Ask TBG at dividendcafe.com, where one is wondering about the growing level of margin debt balances and what it might mean for increased risk in the system. So I'm going to leave it there. I'm going to say happy anniversary to my wife of 24 years, Jolene, and I'm going to thank you all for reading, watching, and listening. The Dividend Cafe.